Welcome to Wealthion. I'm Wealthion founder Adam Taggart. The financial world has been rocked over the past few days as Silicon Valley Bank, the nation's 16th largest bank, which had $209 billion in assets and $175 billion in deposits just as of this December, failed with little warning. This is the second largest bank failure in U.S. history. Shockwaves from this very fluid situation are still in the process of rippling through the tech ecosystem, as many VC-funded startups exclusively did their banking there. And depositors around the country are suddenly wondering how safe their own banks might be. To bring us up to speed on the latest developments and discuss what's most likely to happen from here, former Federal Reserve insider Joseph Wang, who publishes about the inner workings of the monetary and banking systems, has kindly agreed to sit down with me here on a Sunday for this special recording. Joseph, thanks so much for joining us today.
Thanks so much for having me. It's a pleasure to be here, Adam.
Well, Joseph, you are a great expert on kind of the inner plumbing of the banking system and the monetary system. I want to get into the causes for the shutdown for Silicon Valley Bank and for the most likely next steps to come out of it, especially in regards to its depositors. I want to get to that in just a moment, but can you explain what's going on right now at the bank over the weekend as we're talking?
Yeah, so right now, what happened with Silicon Valley Bank is on Friday, it was shut down and taken into receivership by the FDIC. So when a bank goes under, the FDIC basically takes ownership of it and tries to figure out what to do. So what's probably happening right now and what the Bloomberg reports are suggesting is that the FDIC is looking for a bidder, someone to buy Silicon Valley Bank. And that would be a very good outcome because if someone's willing to buy the bank, then all the depositors are probably going to be okay. The worst situation would be that no one ends up buying the bank, and so the FDIC will liquidate it. So what would happen is that the FDIC would give all the insured depositors their money on Monday, and over a period of, let's say, the coming months, it would slowly liquidate the asset portfolio of Silicon Valley Bank and distribute the assets to the remaining creditors. Now, so we may not think of it this way, but when we deposit money in a bank, we're actually lending money to a bank. So we are a bank's creditor. So if a bank goes insolvent, that means that it owes more than it owns. So the FDIC is going to liquidate the assets of Silicon Valley Bank in the event of no buyer and disperse that to the creditors according to a waterfall. So the insured depositors will get paid off. The FDIC will get paid its administrative fees and so forth. And then the uninsured depositors get paid. And after the uninsured depositors get paid, other general creditors get paid as well. But from the situation, it looks like if there is a liquidation, there's not enough money to pay down all the uninsured depositors. They're probably going to get, by my analysis, maybe about 70 to 80 cents on the dollar if that happens. But it's in my judgment, by the time you hear this recording, the government would have figured out a buyer, maybe added a lot of sweeteners to make the deal go through, and things should be okay. But if not, then yeah, a lot of people who put money there are going to lose money.
Okay. So first off, when a bank goes into receivership, like Silicon Valley Bank did on Friday, it's kind of like a SWAT team descends on the bank, right? This is what the FDIC, this is kind of its job, right? It comes in, it does all the accounting, the forensic accounting, figure out, who's going to get paid what according to that waterfall process. And if it can line up a buyer, it tries to line up a buyer over the weekend because its goal is basically these things tend to happen on weekends anyways, because its goal is to basically open the bank's doors for business on Monday if the bank's still going to stay in business, so that people feel more confident in the banking system. Correct? You're nodding as I'm saying all this.
Yeah, exactly. So when a business, not just a bank, any business fails, there's a problem with creditor preference. So we don't want the people to, we don't want people to get paid back according to how quickly they run to the bank. So that's not what we want. If a business wants to go under, we want to have it be liquidated in an orderly way, if it has to be liquidated at all. And so when the FDIC closes doors It's trying to have an orderly process. If it doesn't do that, then you just have long lines, you sow panic and so forth. And like you mentioned, doing this over the weekend is a good idea since, businesses are closed, market is at least closed during the weekend, so there's less panic.
Okay, and you said this is sort of a waterfall in terms of the way the payments get made, and it's basically by sort of seniorage, right? Like who has the best, biggest claim, and at the top of that, I believe, correct me if I'm wrong, but is the insured depositors, right? But when we say insured depositors, we're mostly talking right about the FDIC up to $250,000 in any one given account, correct?
That's exactly right. Those guys will get paid full, so that's not a problem. They're insured by the FDIC, and the FDIC actually has a big insurance fund to make sure that those payments are made.
Right, and real quick on that fund, I've seen on the internet at times, there's only enough money in the FDIC insured fund to insure like 1% or something like of all banking assets or whatnot. Which may or may not be true, and you can correct that statement if you want in a moment. But from what I've also heard is that there haven't been that many bank failures since the GFC, the Great Financial Crisis, Global Financial Crisis. And so I've sort of heard that the FDIC Bank Bailout Fund is actually kind of flush. So in other words, in this particular case with Silicon Valley Bank, there's no worry that the FDIC isn't going to be able to pay out that $250,000 to every insured account, correct?
Yeah, that's absolutely correct. So the FDIC actually is like any other insurance company. It collects a fee that banks have to pay, and in return provides them insurance. And as you noted, over the past few years, there have not been many bank failures. So banks continue to pay into that insurance fund, but the insurance fund has not had to pay out. So just for some context, over the past 20 years, we've had about 550 bank failures. Most of that is concentrated around the Great Financial Crisis time. And so since the past few years, we've had very, very few. I don't think we've had any in the past couple of years. And like you mentioned, the Silicon Valley Bank is a notable one in that it's very large. There are $210 billion in assets. And the ones that have failed in the recent years tend to be very small. So it's uncommon for something like this large to fail. But so for some more context, though, 210 billion is not super big in the banking sector. It's about medium, largest bank. For context, JP Morgan, the largest bank in the US, has $3.5 trillion in assets. So Silicon Valley Bank will be less than 10% of a JP Morgan. So it doesn't pose any systemic risk, in my judgment.
If they indeed open the doors tomorrow on Monday, would somebody be able to withdraw their insured deposit on demand that day, or is
yes,
it
absolutely?
Okay, so it's not like they make it available over time. It's doors open, you can come get it.
If you're an insured depositor, you'll get your money. Basically, that's the first thing they do. So there's zero risk for that. And to be clear, this is a government agency. So even if their insurance fund, quote unquote, is not sufficient, and it absolutely is, but even if it were not, I'm sure the Treasury would kick in some money. So that's really not a concern. The concern is that if you deposit money there beyond the FDIC insurance limit, and there I think losses are very possible.
And let's talk about that, because Silicon Valley Bank had a very high percentage of unsecured deposits, correct?
Exceptionally high percentage, really. It's over 90%, which is very uncommon for a bank. So part of the reason Silicon Valley Bank failed is that it was exceptionally poorly run. It's just a terribly run bank. So, and part of the reason is, like you mentioned, their reliance. So a bank can choose their funding sources. Any competently managed bank would not be run this way.
The startup industry has kind of been going into a nuclear winter here, where the VC funding's been drying up. So startups were not depositing any more funds in Silicon Valley Bank, and instead, with their burn rate, we're just increasingly drawing cash out of Silicon Valley Bank. And that's going to be important for a second, but let me take a breath. Is what I've said accurate so far?
Yeah, you're exactly right. So Silicon Valley Bank, from what I understand, was willing to take credit risks in a way that other banks were not willing to take. They were willing to provide services and loans to some of the higher risk segments of the market, like these startups. And in return, for providing that, they had to keep their deposits in Silicon Valley Bank.
They didn't have any hedges to interest rate exposure. So when they made those loans, they didn't have any insurance policy against it. So they were just having to eat these losses, like I said. And that's when word began getting out in Silicon Valley, hey, the health of the bank isn't so great. Therefore, I want my companies to take their money out. And that just created the vicious cycle that created the bank run.
Yeah, Adam, that's a really good summary. It really is, at the end of the day, an old-fashioned bank run. So just some more context on this. So Silicon Valley Bank is about $210 billion in size. And what's really strange about how they manage their assets, so a bank, when someone deposits money in a bank, they're lending money to a bank. We may not think of it as that way, but when I put $1,000 in Silicon Valley Bank, I can take that money back anytime I want. I'm basically lending it to Silicon Valley Bank, and Silicon Valley Bank, from their perspective, is borrowing money from me. That's the liability side. Now, what does Silicon Valley Bank do on the asset side? Normally for most banks, like a peer bank, let's say First Republic, will be making a lot of loans to mortgage loans or corporate loans and so forth. But what Silicon Valley Bank did was they went and they bought a whole lot of securities. Of their $210 billion assets, 120 billion were in securities. That's very, very uncommon. So First Republic, I talk about First Republic since people are putting them as peers. They do similar businesses and they're about the same size, had about a securities portfolio of about 30 billion. So what Silicon Valley Bank was doing was very different. The credit quality of those securities was pretty good. They're usually lending to treasuries or agency-backed mortgages, which are mortgages backed by the federal government. But that exposes them to a lot of interest rate risk, like you mentioned, Adam. So when interest rates go higher, if you have a fixed income security, the price of the fixed income security goes lower. So the bond portfolio declines in value. So on the books, the securities portfolio was worth 120 billion, but if you market to market, it was worth 100 billion. So they had $20 billion in unrealized losses. It's really hard to talk about solvency, though, when you're looking at a bank. So if you bought a treasury, for example, and then it declined in value, you're sitting on a mark-to-market loss. But if you hold that treasury, at the end of the day, you're going to get 100 cents on the dollar because the government has no credit risk. So even if you have unrealized losses on your portfolio, if you hold it to maturity, eventually those securities, they pay off because there's no credit risk. So what you may look like I think, significant decline in your asset values can over time heal. The problem is liquidity. What if everyone starts to ask for their money back, as Silicon Valley Bank did, depositors in Silicon Valley Bank did? Then you have to sell those securities, and then you realize those losses, and then you might not have enough money to pay your depositors. Now, a competent bank would have managed their interest rate risk, like you mentioned. What banks usually do is that they put on hedges so that when interest rates go higher, even though they lose money on the bond portfolio, they make money off the hedges. So net on net, their asset values don't decline too much. Silicon Valley Bank was very, very, I guess, unique in that they basically had no interest rate hedges. So they were, in a sense, having this huge YOLO bet on interest rates staying low forever, to an exceptional size, $120 billion in fixed income securities. And that did not turn out well for them.